Welcome back. This is part 2 of my review of the 18 final notices issued by the FCA, leading to fines of just under £400 million. In this video, I'll be looking at the significant issues identified in relation to how banks are using technology and data when it comes to anti-money laundering. So let's break down exactly what the FCA found and look at some specific examples of where organisations are going wrong. First, let's talk about data. The FCA reports found major problems in data quality, data governance, and data completeness across multiple organisations. These issues seriously impacted the effectiveness of the bank's transaction monitoring systems, its reporting, and its overall AML framework. Let's look at a couple of examples. Commerzbank. The FCA found that their main transaction monitoring tool was severely impacted by poor data. This led to a large influx of false alerts, but conversely, also those alerts that should have triggered didn't trigger and therefore weren't investigated. On top of that, within the report, the FCA said there wasn't enough investment in the tools and IT support was lacking. So it's a clear sign of poor governance around data. Switch to HSBC's report. They had a number of data-related issues around transaction monitoring. Again, for instance, they didn't keep a complete list of their correspondent banking relationships, which meant lots of transactions weren't being monitored at all. They also had inaccurate data feeding into their systems, including problems with things like transaction code identifiers, customer codes, making their monitoring ineffective. The FCA also found that HSBC didn't reconcile their data properly for years, even after external recommendations, and that clearly significantly impacted data completeness and accuracy. The report goes on to suggest that HSBC knew about these problems as early as 2010, but didn't fix them, demonstrating poor data governance again. Moving over to Metro Bank. Metro Bank had a huge problem, which was simply referred to as bad data. Basically, customer accounts and transaction information was being rejected from their automated transaction monitoring system, largely because the data was either missing or incomplete. Because of this bad data and weak exception processes, lots of transactions weren't being monitored, which of course is a major risk when it comes to spotting suspicious activity. The FCA also found that Metro Bank didn't fully grasp the level of risk tied to these unmonitored transactions. Staff had raised concerns about the bad data back in 2017 and 18, but senior management didn't take it seriously until external consultants flagged the risks in 2019 and 2020. Again, a broad data governance failure. Let's move on to technology issues. The FCA report highlighted both the potential of using technology to fight financial crime, but also pitfalls if it's not done correctly. In terms of opportunities, they said that challenger banks, for instance, were leading the way in some areas of managing financial crime. Things like using data and technology really effectively to do things like customer identification and monitoring. They're utilizing tools like video selfies, geolocation data, photos on passports to streamline processes and make things more secure and effective. They also went on to reiterate something we all know, that automated transaction monitoring systems can be a real game changer for AML. They can analyze huge amounts of data, spot unusual patterns, and flag potential risks much faster than humans can. The FCA went on to encourage banks to use these systems, especially for high-risk customers and complex transactions, because sometimes those sort of activities are done more manually than through the systems. And then they touched on machine learning. They actually mentioned stopping mule account activity through this. They said that machine learning can be a very powerful tool to use against money mules. They can analyze data and transactions, identify suspicious activity, and allow banks to shut down money mule networks far more effectively and quickly. They went on to suggest that potentially machine learning or AI could adapt more quickly to emerging financial crime risk or fraud tactics, something traditional rule-based systems struggle to do. And they did mention some challenges around tech. Keeping up with technology is changing rapidly, especially when it comes to things like crypto assets and online payments. And the FCA says that banks need to keep up with this, and this means investing in new technology, training staff, and consistently and constantly reviewing and updating risk assessments and controls. He also talked about resource and oversight. Some banks, especially those growing quickly and making big changes to their business, are struggling to keep on top of their AML controls and aligning it with their risks and risk assessments. In that light, the FCA found that some change programs had weak management, slow implementation, and not enough oversight. This leaves the bank vulnerable to financial crime. So the message is clear from the FCA. Organisations need to dedicate enough resources to AML compliance and ensure that change programs are properly overseen and managed. The third challenge, somewhat conversely from the other points, is around over-reliance on tech. The FCA warns that relying too heavily on technology without looking at the bigger picture, the more holistic view, and therefore not aligning this with other activities like proper due diligence on the customer. So the FCA emphasised a need for a risk-based approach where the technology works alongside things like customer due diligence and ongoing monitoring, as opposed to replaces those elements. So there you have it. The FCA report reveals and highlights that many organisations are struggling to keep on top of their AML responsibilities, particularly when it comes to technology and data. While there's some exciting opportunities to improve AML systems using tech, banks need to address the challenges head on. Otherwise, of course, they face the risk of further fines, and more importantly, they'll fail to stop the flow of dirty money. Thanks for watching, and if you enjoyed this video, please like and subscribe. The next video, I'll cover findings related to the Money Laundering Reporting Officer, internal audit and compliance, and oversight. I'm looking forward to coming back and sharing my insights.